Andrew, to bring you into the conversation, and not just to talk about equity or credit, but just to talk about commodities right now. These guys are reacting to the reality that we could be here at $50 for a while. How do things play out as you see them right now?
Yeah, look, I'd agree with many of Javier's comments there. I think this lower for longer notion is suddenly being priced in. You know, in addition to the comments Javier made, we've also, of course, got the Iran deal. That's not imminent in terms of increase in production, but I think if we look into 2016, it could be another 400 or 500, maybe even as much as 700,000 barrels a day onto the market. The excess supply situation we have is shrinking, but it's shrinking really slowly. So the notion that we might be in this sort of more range trade type market for oil for 12, 18 months, maybe longer, I think is what we're seeing priced into markets now.
We can talk about the reality of some of the cuts, the capex, and what that means for 5 to 10 years' time and what it means for oil. I want to talk about the dividend. If I'm an investor, I want my dividend. Shell just promised me a dividend next year. Why did they do that, and can they actually keep to that commitment?
I think that they can, because there is a very interesting number on their statement that they say what is going to be the combined investment by BG and Shell next year. And they said that that's going to be $35 billion. When they announced the deal 3 months ago, that number was $40 billion. So all of a sudden that you have another $5 billion extra next year that they have been liberated, that they can be used to fulfill that promise of the dividend. But right now, what we have a very interesting situation is the dividend looks a lot more safer than it was looking only a few weeks ago, and all of a sudden the share price is increasing, obviously, but what you are looking at is a dividend yield for Shell of almost 7%. In a world where interest rates for most governments are around 1 to 2%, Shell is yielding today on a dividend, on an implied dividend, 7%, and for investors that could be a pretty good proposition.
I'm going to ask Andrew that exact question in just a moment, though. What I do want to do, though, is get to some of the sound that we spoke to the CEO of Shell just a little bit earlier about those job cuts, about that cut to investment as well. Listen to what he had to say.
This is, of course, the result of a multiplicity of programs that we have going on throughout the company, focusing on bottom line improvements. Of course, to some degree, it has to do also with restructuring and exiting businesses that we have. And if you just add up the tally for this year, it comes out to 6,500. But it's not a new program. It is basically adding up what we have in motion, and this is the result for 2015.
That was the CEO of Shell, Ben van Beurden, reacting to those job cuts that he's announced, and of course the cuts to investment as well. Andrew, when you look at these cuts, when you look at the reshaping of a strategy possibly for the next 2 years, is the opportunity for you now in equity with the yield that Javier's talking about from the dividend, or is it in credit?
Yeah, look, I think we see good opportunities in the credit markets because we've seen a marked sell-off, particularly in certain sectors. It's interesting, you know, when we had the initial fall in the oil price, it was pretty indiscriminate. Now we've seen some bifurcation between those companies. Financing is good, they're able to access capital markets. Those companies actually haven't sold off very much. You haven't seen those yields rise. But in other sectors where people are doubtful as to whether they'll be able to get financing, extend credit lines, that process happens in the fall, we're seeing yields in the region of 10 and some as high as 12%. So some of those companies are certainly going to have difficulty, particularly if oil stays around these kind of levels. But we do think there's opportunities where some companies get financing and will be able to be very profitable, even at oil prices at these levels.
You and I sat here about 12 months ago, and we talked about the high-yield space and how energy accounted for about 15 to 18% of it, and we talked about these horror stories. And as always, I got a bit excited, and you talked me down and told me to calm down, and we sat there. And you know what? You were right. It hasn't ripped through the high-yield space in the way a lot of people thought. In fact, maybe what surprised a lot of people is that venture capital, private equity came into the market as well and carried on funding these guys. Is that what supports them as well?
Yeah, look, I think there's a lot of liquidity around. You know, don't forget there's still a lot of QE. So that liquidity is still finding its way into the market. In the same way that the last few weeks, we haven't really seen the rest of the high-yield sector move at all. So, yes, high-yield yields in aggregate are up. We're about 7% now. It's really the energy sector and those smaller sectors that support the energy sector. Away from that, actually, things have been pretty calm. So it's really the market focusing specifically on the energy sector.
Javier, to wrap things up with you, what a week we have had. You've effectively been working for TV all week. You've been sitting here breaking down the numbers. BP seemingly the only oil major that actually missed. As I look at the strategy of Shell, I see a multi-decade strategy to eventually become a gas company, and you correct me if I'm wrong. But when I look at the Totals of this world, they've got this big refining business that keeps things looking healthy for the next 1 to 2 years. If I'm an equity investor and the analysts and investors that you're speaking to right now, do I want the Total strategy or do I want the multi-decade strategy of the Shells of this world?
Well, I think that they are indeed very similar because Total is also trying to shift into gas. BP is shifting into gas. Shell is shifting into gas. All the major oil companies, at some point, we're going to have to talk about big gas rather than big oil. Everyone on the oil sector is trying to do more gas. And I think that that is going to be a thing that we're going to be listening for from CEOs, particularly on the run-up of the big climate change in Paris. And investors like it because it's more sustainable, probably it's better for the long term. But if you are looking at refining, Shell has a very good refining system and it's demonstrating it. And I think that tomorrow, Friday, Exxon is reporting and they're going to also demonstrate that they have a very good refining sector.
We've talked about Shell for about 10 minutes and not once mentioned BG. As a multi-decade strategy, we can talk about whether it still makes sense. 3 months on, does it look expensive?
It does a bit expensive, yes. And I think that what the language today of the CEO of Shell demonstrate is that probably it was a bit expensive.